Well, good afternoon, everybody. Welcome to our webinar entitled S Corps, C Corps, and LLCs, the alphabet soup of tax strategy. My name is Aaron Mall. I'm the Executive Vice President here at iTValuations, and I'm joined today by Greg Northrup, our Director of Tax and Finance. Greg, how are you today?
I'm doing well, Aaron, and yourself?
I cannot complain. I cannot complain. It looks like from today's attendance, we have a few who also joined us in June at our webinar entitled Knowing and Growing Your Valuation through Valuations as a Service. And as those of you who are on the call may remember, I was in Cooperstown, New York at my son's baseball tournament, living the risky life of Holiday Inn Wi-Fi. I was a little nervous heading into that webinar, but things worked out okay. And but we used my location at the baseball mecca to toss out a question and award a gift card. We're going to do the same thing today. So the question back in June was, what was my favorite baseball team? And we awarded a $50 Amazon gift card to the person who correctly identified it as the first place Cleveland Guardians. On a skid right now, a little concerned, we'll be very honest with you. But today, we're going to do a similar thing. We want to give out a gift card. And so to those of you who are on this webinar, we want to know, what is Greg's favorite soup? Obviously, the title of today's webinar is about the alphabet soup of tax strategies. So if you know Greg's favorite soup, put that guess in the comment section of the webinar. And if you're the first one to get it right, we'll send you a gift card along with the deck. We already have a guess for New England clam chowder. Greg's not in New England. He is in Minnesota. That's the only clue you get. But feel free to drop that in the chat, and we'll check in from time to time. I'll check the chat as we go to see if anyone has won that gift card. A couple of quick housekeeping items before we get started. The first thing that I want you to do is save the date for our next webinar, which is in August. You can advance the slide. We'll do a session with Reed Warren, our CEO, on the M&A landscape and how to be successful in that landscape. Whether you're thinking of buying or selling within the next 6 months or 6 years, just a great context on the current market, what we're seeing in the marketplace in 2024. And spoiler alert, a lot has shifted even in the last 6 months. Where we were in January, the trading is different, the multiples are different. And so again, a great chance to join this free webinar as we get into August. And then in September, we're really excited about our September webinar as well, the transaction journey. If you're going to transact, whether buying or selling or merging, at some point you have to answer the question of why. What's your why? And what's a good fit for your transaction objectives? And so we've asked one of our clients, Stephanie Kinsey, Total Network CEO, and Arlen Sorensen of ConnectWise fame, to join us, and they'll both be facilitating that conversation around fit and the fundamentals of fit. So excited about our August lineup, our September lineup. I'll drop those two links to register in the chat here shortly, but wanted to put those on your radar for August and September. Okay, enough housekeeping. We are here for a dynamic discussion around taxes, which is what Greg is passionate about. So Greg, first, thanks for taking your time today to walk us through these different entity types and why or why not. Some people may choose one or over the other. But maybe before we start, by way of background, can you introduce yourself, your background in tax and finance, and maybe your role here at iTValuations?
Yeah, good afternoon, everyone. Nice to be here with all of you and to talk about kind of a maybe less talked about topic when it comes to entity selection. A lot of companies just kind of select their entity and then just kind of ride that out until they sell their company. But really actually being able to dive into this topic of does the entity that I have in place right now actually meet my goals and objectives of my company, and what are some kind of key facts within my fact pattern or goals or objectives that might change or manipulate what entity structure is probably the best fit for me. So really excited to kind of walk you through all of that. But by way of background for myself, I worked in public accounting at a large CPA firm called BDO, fifth largest in the world. I headed up their private client service division, working with high net worth individuals and their families, with net worths of over $3 million or more, all the way up to 10 billion, and really worked with wealth transfer strategies, selling the business off either from one generation to the next or selling it to private equity, and then really getting into kind of just unique tax structures and tax, manipulation is a hard word, but really trying to optimize.
Careful, Greg, we're being recorded. I just want to
Yeah,
make sure
exactly,
we're
right?
being
Yeah,
recorded.
we're not trying to, teach you how to do tax evasion, but we're trying to implement like tax minimization strategies where given your set of facts and circumstances and your goals and objectives, what is ultimately the best, like, blueprint to save the most amount of money in taxes. And so that's what I worked with those families for nearly a decade there. Came to ITV last fall and have been a part of the ITV team, really heading up our evaluation as a service, like service offering, and really overseeing all of our evaluations here at ITV. And then most recently, we just started a CPA firm, IT CPA, that you see there's my background. And that's kind of the context for this conversation, is really the IT CPA mantra is really trying to let's question everything and make sure everything that you have in place today is truly in alignment with your goals and objectives of what you want, not just from a minimization standpoint, but even a legacy, go forward, possible transaction in the future standpoint, that you're truly set up for success today, tomorrow, and into the future.
That's great, Greg. Thanks for the great intro. Looking through the alphabet soup of entities, all the acronyms that are used in the space, can you briefly explain the core differences between S corps, C corps, and partnerships?
Absolutely. So I have a couple of slides to kind of walk through each of the three different types of entity structures, but just high level. When we're talking S corps versus C corps versus LLCs, as in the name of this kind of webinar, the context of LLCs is we're looking at LLCs as multi-member LLCs, which are then taxed as partnerships by the IRS. Technically, an LLC can be a single member LLC and disregarded. An LLC can be an S corp, an LLC can be a C corp, an LLC can be a partnership. So technically, an LLC can be all four different types of tax structures. And so when we're referring to LLCs in this presentation, we're really referring to it in that multi-member partnership context. But really, when you think about those three different types of entities that we're looking at, S corps are the most common entity choice for small business owners. It's the easiest one to set up. You are a single member LLC. You just file a form, and all of a sudden, boom, you're an S corp. C corps are the most common entity structure for companies of $100 million net worth or more, because again, when you start getting to economies of scale and trying to manage investment dollars of that magnitude, a C corp structure is probably the easiest. Specifically because there's also certain limitations that we'll go through on an S corp side, that you kind of grow out of the S corp structure and you have to be a C corp. And then the partnership side is really the most flexible entity structure, where you could be $1 billion partnership. There are $1 billion plus partnerships out there. Or you could be, a few $1,000 partnership. It really kind of depends. Partnerships just give you the most flexibility to truly accomplish your goals and objectives. And I would argue it's probably one of the least talked about tax structures out there, because most people think, oh, I'm either going to be an S corp, or if I get to a certain size, I become a C, and really just want to bring people into the fold of the value in partnerships. I think there's value in all three of these entity structures, but specifically when we're talking the MSP space, there's a lot of value in partnerships that I feel gets overlooked, and we'll kind of talk through that in terms of the reasons for choosing a partnership versus not.
That's really good, Greg. I wonder, just if we focus in on S corps for a minute, can you walk us through a scenario or a fact pattern where it might be beneficial for an owner to choose to be an S corp?
Absolutely. Yeah. I mean, really, S corps, like I mentioned, are the easiest entity structures to set up. The most common fact pattern, I laid it out there in a diagram. I kind of like the shape diagrams. I'm a very visual person. And so you can kind of see that disregarded single member LLC files a simple form with the IRS, Form 2553, and boom, an S corporation is sprung to life from the effective date of that election, which you can reach back 2.5 months from the date that you filed that election. And actually, you can even reach back to the beginning of the year. So I could file an election right now to retroactively treat my disregarded, LLC as an S corp as of January 1st, 2024. And so that's the most common fact pattern. I work with a lot of small businesses, or have over the years, where they have their single member LLC. They're subject to that 15.3 self-employment tax, which is the Social Security and Medicare taxes on both the employee and employer portions. And people try to avoid that 15% tax by putting a corporate veil in place, by setting up that S corp. And essentially now, instead of having all of their earnings in the business get subject to self-employment tax, only the portion they pay out to themselves on a W-2 is subject to self-employment tax on that W-2. So it's definitely a very easy tax saving strategy initially for a small business owner. But the limitations of that S corp are really it doesn't really scale well because you can't have more than 100 owners. You everything has to be pro rata. So if all of a sudden I want to bring Aaron into the fold of my S corp, I have to give him a percentage of my equity in order for him to come into it. So I can't carve out a certain amount above and beyond what I've already built up in my business. I'm actually giving him a portion of what I've already built, whether in
Right.
the form of a sale or a gift or otherwise. And so, it's really an inflexible structure when it comes to how do I get maybe give out equity to employees or future, acquirees or whatnot down the road.
Yeah, it's interesting. You talk about the lack of flexibility with the S corp for mergers, acquisitions. Yet the majority of companies that we at ITV work with are S corps. So,
Yep.
what are some of the ways in which companies are able to still do transactions, still be involved in those as S corp? And are there specific things that maybe C corp owners can't or shouldn't do?
Yeah, I mean, with S corps, there's a bunch of tax-free reorganization rules and laws out there. The specific one that pertains to S corps is an F reorg, and maybe many of you on the call have heard of an F reorg before. All an F reorg is doing is converting your operating S corp into a disregarded LLC that is wholly owned by a new S corp. And now you can sell that disregarded LLC because, like I mentioned at the front end of the call, an LLC can be a partnership, an S corp, a C corp, a disregarded entity. You can now sell the units of that disregarded LLC to any entity type in the marketplace, and they can convert it into either a subsidiary, brother, sister corp, or whatever structure they want it to be. So there's a lot of flexibility from that point once you do that F reorg. But by definition, your operations are no longer within an S corp structure when you do that F reorg because it's technically in an LLC disregarded entity structure with an S corp blocker, which is where you file your tax return. Another strategy with S corps is, when you bring multiple S corps together from a merger standpoint, um, I've seen a lot of owners try to then figure out, oh, how can we make a new S corp with our two S corps coming together? We make a new S corp. Well, the problem with that is S corps can't own other S corp stock unless they own 100% of it and make it a disregarded entity. So when you get to that merger conversation and you have two S corps wanting to merge together, they can't actually create a third S corp in a tax-free manner. So the easiest way to do that in a tax-free manner is to create a partnership. Or sometimes you actually see those companies create a C corp if they, believe a C corp accomplishes their goals and objectives.
Great summary, Greg. It's really helpful. For those of you who may have jumped on late and you look in the chat and say, why are there random soups just chatted at? I want to just point out that we are giving away a $50 Amazon gift card if you are able to identify Greg's favorite soup. And so that's what that's there for if you missed the opening intro. I will say I have not seen the correct answer yet, but I'm going to give you a little bit of a hint. It is a chicken base. And so if you start with chicken, you might have a better chance of winning. Great. We've talked about S corps. You touched on that pretty briefly, and even now on C corps a little bit. But could you walk us through maybe a fact pattern where choosing a C corp makes the most sense?
Absolutely. I actually just ran into this with a merger we're working on where, two S corps are coming together. Or actually, it's an S corp and a C corp are coming together, and we started looking at what makes the most sense for their fact pattern. And so when you think about goals and objectives in the MSP space, there's just this really high initiative, it seems like, in the marketplace around trying to raise your revenue, raise your EBITDA in whatever means possible, and to get an exit at a high multiple, whether it's to private equity or a PE-backed MSP, or there's some sort of roll-up or tuck-in type of opportunity for your business in order for, there's a lot of a lot of MSPs are transacting over the next 3 to 5 years. And so when you think about from a transaction standpoint, if you already have a goal in mind of when you want to transact, you can kind of work backwards to say, okay, what's my timeline and what is my ultimate goal and objective? If my ultimate goal and objective is to grow the business through acquisitions and I need as much cash in the business as possible, well, I'm probably not taking distributions out of the company. I'm probably not living off of the income of the business from a lifestyle perspective. I'm truly just taking my salary and that's it, and then reinvesting all the rest of the earnings in the business. All right, well, that's a good fact pattern for a C corp because if you were to take those distributions out, you'd be subject to double taxation in the form of a dividend. So that's the number one fact pattern. The number two fact pattern is if you have a desire to hold on to the company's stock for at least 5 years, maybe you have a 7 year roadmap. Let's say you're age 55 and you're like, by age 62, my wife wants me out of the business because she wants me to be retired, right? Or whatever the fact pattern is for you that you're like, I have a 7 year roadmap, 5 year roadmap. Maybe it makes sense to become a C Corp because of Section 1202 for the qualified small business stock gain exemption, where effectively, if you converted your existing S Corp into a C Corp and then ran that course of events for 5 years, essentially any appreciation in your value from the time you converted to a C Corp to the time you exited, that gain would be exempt from income taxes. And that gain is limited to 10x your basis, so effectively 10x the value that you rolled over at the time of conversion from your S to a C, or $10 million. Now it's the greater of those two amounts. So if you roll over your $5 million MSP to a C corp, and that $5 million MSP becomes a $50 million MSP upon exit 5 years from now, you just saved $45 million in capital gains. And so from a tax standpoint, that's the equivalent of $9 million federally, and potentially if you have a state tax liability, whatever your state tax rate is on that 45 million as well. So really, those are kind of the two primary drivers. If you're not taking distributions and you have a 5 to 7 year runway of potential exit, it potentially makes sense to be a C corp, specifically because that lower tax rate of 21% to 37%, you're automatically leaving more money in the business for acquisitions. And then that other opportunity of that qualified small business stock gain exemption, they go hand in hand. That if all of a sudden you're taking advantage of one and you get to take advantage of the other, effectively you get to just save 16% every year on income tax and then save a final 20% on the gain when you exit. So it's the most tax optimal strategy out there if that aligns with your fact pattern.
Yeah, I mean, tax exemption, one of my favorite phrases, candidly, if I'm being honest. When you have worked with owners in your career, how many of them have taken advantage of the exemption? And is there a certain fact pattern where it makes sense to pursue beyond the, 5 to 7 years out?
Not a lot have, and I think the reason that a lot haven't is there's a couple reasons. Number one, most people when they have their business, it's really hard to not live off of the distributions of the business in conjunction with the salary that you're taking, right? You
Mm.
look at your tax return, you're like, I made $1 million last year, but it doesn't feel like it. And so you see some of these lifestyle businesses birthed, or even just, certain lifestyles are birthed for these owners that they need a certain amount of cash flow to fund their lifestyle. And so I see a lot of people get tripped up just by that, rung of the ladder, alone. There's other components with a C corp where you have to be a lot more strict on personal write-offs, where maybe you have a little bit more flexibility in an S corp structure. And so people then say, well, that's a deal breaker for me because I'm trying to minimize my taxes year in and year out with personal write-offs. Um, that's usually the biggest hurdle. The other hurdle is um, people don't necessarily know what that exit looks like, and so maybe they're possibly thinking I might want to transition it to my kids. I might want to transition it to my management team or internally. And depending on what you're looking at from a transition, that transition opportunity may not actually require or be allowed to take advantage of that Section 1202 gain exemption. And so you might say, well, why would I force myself into a C Corp structure if I'm not going to take advantage of that exemption? Most common question I'm asked though on C Corps is, well, in order to get this 1202 exemption, it has to be a stock transaction then, correct? And don't all buyers want an asset deal versus a stock deal? Well, you're correct in that. All buyers really want an asset deal versus a stock deal. But what makes the MSP marketplace so unique is that none of your companies, unless maybe you are heavily product centric, you're not really asset intensive businesses. What you're truly selling to a buyer is a customer list. And so that customer list being an intangible asset, whether the deal is a stock transaction or an asset deal, is really not going to make all that much difference to the seller or to the buyer per se. So then as a seller, I can maybe command a stock transaction without maybe taking a haircut on consideration or negatively affecting a buyer or potentially pigeonholing me against, what opportunities are out there for buyers. Because I would say the PE groups I've worked with over the years, a lot of PE groups actually like stock deals because it actually works better in their portfolio strategy than doing the asset deals. But it depends on the PE group. Every PE group is a little bit different.
Yeah, that's really good to know. Great summary. I think, the last structure you talked about was the LLC tax as a partnership. And
Yep.
I'd love for you to walk us through what it looks like and maybe the pros and cons of what a partnership is.
Yeah, so diving into kind of partnerships, the the reason why you do a partnership is you have more than one owner, right? So if Aaron and I wanted to start a business, it's in our best interest potentially to be a partnership rather than an S corp, depending on what our goals and objectives are. So for example, if Aaron and I really want to grow through acquisitions and we want to be nimble and flexible to potentially offer rollover equity as a component of the transactions that we're looking to do. Or maybe we want to incentivize our management team with potential stock or equity incentives. Those opportunities are endless on the partnership side of things. They are very limited in an S corp structure. So in a partnership, you can have unlimited number of classes of units. You can have, different tranches or tiers that say, if we bring on, I'm just looking at our audience here. If we bring on Scott as a third partner in our partnership, we could have a cutoff that says Scott doesn't actually get a dollar added to his capital account until we exceed a balance of $10 million. So we can essentially give him this future profits interest once our company grows to a certain size. So it allows you to have a lot more control over how much value you're sending out the door to employees or future acquirees. Um, in that S corp structure, like I mentioned before, you're giving up your own equity. So effectively, you're very limited in that ability to kind of transfer or carve out, shares for an acquiree or for your employees. Um, the other nice thing with partnerships is things don't have to be pro rata. So just because Aaron and I are 50-50 owners in a partnership, we don't actually have to split profits and losses 50-50. So where this, and Dan, great question. Your trust can be a partner in a partnership. And only certain trusts can be shareholders in an S corp. All trusts can be partners in a partnership. So that's a great clarifying question. But when you're thinking about Aaron and I as 50-50 partners, let's say we're doing a merger. Aaron's bringing his MSP, I'm bringing my MSP together, and we're going to form a partnership. Well, maybe Aaron's MSP is bigger than mine, or maybe Aaron's MSP has a certain service offering that's on a higher growth trajectory than what my service offering is. We can, again, partnerships, there's an endless, unlimited number of opportunities. You can get things pretty complicated pretty fast. But it really comes down to what are your goals and objectives. So if we wanted to lock in, all right, Aaron gets appreciation in the value of his units relative to what he's bringing to the table from his business growing, and I get appreciation in my units relative to the appreciation in my business, we can set it up that way and the income loss can be split based on how our businesses are functioning beneath the surface or within our service lines. That could be a really unique strategy to reward certain key management members of your team, where if Aaron's overseeing a certain division or product or service area of the company, I can incentivize him based on equity compensation relative to the financial performance of that singular portion of the business. Now, again, anytime you do that, you're creating a lot of work for yourself on the back end to actually then go through that calculation year in and year out. But it comes down to if that's a desire of yours to reward people in that manner, if that's a desire of yours to potentially attract talent or attract a potential acquiree to your business line and give them that upside to incentivize them, that flexibility exists in a partnership where it doesn't in other structures.
Hmm. That's really good. It feels like, I mean, maybe this is the simplification of the century, but these different options really vary based upon what your business objectives are and
100%.
what the short-term and long-term goals of your organization are. And I think so many times it feels like a lot of folks, especially as they head into transaction work, they've done what they can to minimize taxes in the short term because that's what their goals have been. But then sometimes the goals change, right? I think that's why this conversation is so important. I want to pivot real fast to the talk about private equity in the marketplace. And you mentioned you worked with several private equity firms before even coming to iTValuations. Can you talk a little bit about what the private equity's most common structure was and how they operated that structure and how they typically acquired additional businesses?
Yeah, so I got the privilege in the last kind of 2, 3 years of my career at BDO. I got to work with a number of PE groups. One specifically, I got to basically start with from the ground up. I was there with them when they started their first fund, and they were on their 12th fund by the time I left. And so got to kind of set them up from scratch, really get familiar with their operating agreements. What were their goals and objectives when they were setting up these funds? What were they going after from an investment standpoint? And just how critically analytical they were in choosing the right structure for their business model because they laid out their goals and objectives and said, we want to craft something that fits this. And the
Mm.
most common structure that these PE groups were using was a partnership model. And the reason for that is they came to the table with all these goals and objectives that we want to bring this much capital to the plate. We want to see this much return. We maybe want a tiered return where we pay out a guaranteed return to our limited partners. And then after a certain guaranteed rate of return, we actually get a bigger slice of the pie if we overachieve and go beyond that. And again, you don't have that flexibility within any other structure to command those type of terms. But in a partnership model, you can, and it's called a waterfall calculation. I don't want to bore you with all the details of what a waterfall calc is. It gives me a lot of joy to talk about waterfall calcs, but it might not for you guys. But effectively, a waterfall calc allows you to set criteria that the allocation of income changes as you hit certain levels of income payout or certain levels of value creation within the business. So it's a very enticing strategy when you're thinking about bringing on investors to say, hey, if you invest in my PE fund, you're going to get this guaranteed rate of return. And then after that point, you're still getting this percentage. And after this point, you still get this percentage. So it's like essentially it's a win-win scenario for those investors. And then the fund themselves, that's how the fund makes money. And so with that, they're commonly in a partnership structure because they're partnerships. They typically like acquiring the stock of companies and making them C corps as one option, or they like acquiring other partnerships. Those are really the only two models that they of or structures that they acquire. So that's why when we talk about with S corps, a PE group is really never going to acquire an S corp. Number one reason is they probably trigger that more than 100 shareholders issue right out of the gate because they probably have more than 100 investors if they really look down to their effective ownership group. And so essentially they're looking to acquire those LLC units. They're looking to acquire that partnership or that C corp in an attempt to pull it under their structure so that a C corp is probably more enticing to them because they don't have any taxable income roll up to the actual fund. They can leave all the income down at that entity level, but effectively those type of structures allow them to accomplish their goals and objectives more easily. And then quickly, Aaron, I just wanted to jump into one of the questions in the
Sure.
chat. Um, you are able to convert an S corp into tax-free into a C corp. Um, and so essentially what you would do is whatever the value is of the S corp when you convert it to a C, you're kind of locking in that's your new basis. If you're thinking of Section 1202 gain exemption, you don't get to have that carryover basis from that standpoint, but you do have carryover tax basis from the standpoint of when you go to sell. Let's say I have $500,000 of basis in my S corp, and it's worth $5 million at the time I'm trying to convert it to a C. I'm deferring $4.5 million of gain until I have that future liquidity event. So I'm doing a tax-free reorg from an S corp to a C corp. That 4.5 million is built in to my C corp as a capital gain when I sell. And then that appreciation over the 5 million, that's the gain that I potentially, if I meet all the criteria of Section 1202, that I could potentially exempt from income tax down the road.
That's great, Greg. Thank you. I want to give you a little bit of a chance to talk about ITCPA. It's obviously something we've just launched this week. but it's been in process for a long time. And of course, your experience is pretty substantial in the space. Why ITCPA? Why now?
Yeah, so really, when I came over from BDO, didn't really necessarily figure I was going to be starting a CPA firm with Reed as part of that journey. But the more and more I talked with companies and owners, the more and more I saw a need in the marketplace for a CPA firm that really comes with a different vision and vantage point as to how we approach tax. It seems like there's a lot of CPA right now in the industry. The average age of a CPA is 63 years old. So
Mm,
there's an archaicness to the CPA industry where the approach has kind of been stale and the same for decades, where it's let's minimize the tax liabilities, try to flush everything through the business. And there hasn't been a lot of adaptation to, changing mindsets, changes in the marketplace, or potentially even just different goals and objectives out there besides just tax minimization. You know, I would say I don't like paying taxes, but I also like making money. So if you like if you make money, you're gonna pay taxes. You just don't want to pay more than your fair share. So what we developed with ITCPA was really this full service offering where no matter what you need, you kind of have a locked in all-in cost to accomplish all of your goals and objectives, where we'll sit down with you, we'll lay out what are your goals and objectives, how are we going to get there, do we need to change the entity structure, do we need to change your estate plan? Do we need to change, any other components of your business, like method changes, depreciation, however, whatever you're doing in your business, in order to try and help kind of take a different perspective, maximizing value and setting you up for success upon a potential exit down the road, while also minimizing taxes in the process. And there was one idea that I had when I created this is at BDO, I cringed at the idea of calling my clients with ideas because I'd have to bill them every time I called them because I was paid, I was billing by the hour and my bill rate was 750 an hour, which was just insane. And so
mm.
part of this idea with ITCPA is you have a flat fee for the entire year. It's paid in 12 equal monthly installments, almost kind of like a subscription, and then I can pick up the phone and call you with an idea. If I think, okay, Aaron, I believe this might actually be a good idea for your business, I can call you and it's not to no charge to you. Or vice versa, if you call me and you have a question, it's to no charge to you to kind of walk through that, model it out, and really find out if that's the right answer for you. And so it kind of takes the unknown like cost component out of the equation and really allows us to kind of step into almost kind of that financial advisor type of model where your financial advisor is not billing you for those meetings that you're sitting them down with them because they're billing you a percentage of the assets you have invested with them. It's kind of that similar model that we really want to put that client experience first, meeting those goals and objectives as part of that process, and making sure that we're aligned with you as your trusted advisor all along that journey.
That's great information, Greg. If you want to get some time with Greg, it won't cost 750 an hour. Okay, like the quick consultations is free. It's complimentary. I had to add that word to the slide because once you hear 750 an hour, you probably just fall out of your chair. But if you want to get a quick conversation with Greg, 15, 20 minutes on just maybe how ITCPA can help you in your business objectives, you can scan that link. That link can also have you sign up for a demo of our VAS model, which is Valuations as a Service annual evaluation with 3 quarterly updates tracking value creation year over year, quarter over quarter, tracking 24 drivers of value. It's more than just operational maturity. It is